Thank you very much, Warren. As I begin my presentation at today's annual meeting, you'll see on the screens behind me 4 distinct colorful images. Now, these are the same images from the cover of our annual report, and people don't always believe me, but these are images of our products, which I think are absolutely beautiful. The first 3 images are extreme close-ups of copper from our Cecil facility, steelmaking coal from Green Hills, and zinc from Red Dog. And then the bottom image is the view of the world at night, which I think in particular highlights the importance of the materials that we produce and the increasing global demand for those products. But before I go any further, as is required by securities regulations, I need to draw your attention to the important note concerning our use of forward-looking statements and information in this presentation. Forward-looking statements involve risks and uncertainties and are based on numerous assumptions, and many factors may cause actual results to vary. Certain of these risks and other factors are described in our public filings with Canadian securities regulators and with the SEC. We do not assume the obligation to revise or update any forward-looking statements except as required by law. So I'd like to start by thanking some of the people who've retired from our senior management team over the past year, and these are shown in the order that they retired. First, Roger Higgins, who was our Senior Vice President, Copper. He oversaw a period of growth in that division that led to record copper production in the year that he retired. Michael Allen, next on the list, was Vice President Engineering, and he led our technical team. One of the highlights of his career was leading the technical team during the development of Antamina. And then earlier in this year, Bill Fleming, our Vice President of Engineering and Projects and Business Improvement, he retired. He was critical in the integration of the Elk Valley Partnership and forwarding into Teck itself. More recently, Ron Vance, our Senior Vice President Corporate Development, who over the last 8 years saw us through mergers and acquisitions that allowed Teck to grow, and we just had his retirement dinner on April 1st. And then just this week, Doug Horswell, our Senior Vice President, Sustainability and External Affairs, before Marcia took that job, and he spearheaded the development of our sustainability strategy over many years with both Teck and Cominco, and also our zinc and health program. So on behalf of everyone at Teck, I'd like to personally thank each of all of those gentlemen for a tremendous contribution to building our company. I'd like to begin talking about our core value of safety. And as I've said many times before, at Teck, nothing is more important than the safety of our people. In 2013, we rolled out the next phase of our Courageous Safety Leadership Program, which is designed to further develop and embed our culture of safety. And I'm pleased to report that in 2013, we recorded the lowest total reportable injury frequency, TRIF as we call it, in our history, and that represented a 5.6% improvement over the previous year, and also our lowest lost time injury frequency, which declined by 26%. But as Bob mentioned, despite these accomplishments, we did have a fatality earlier this year at our Coal Mountain operation. And this was a tragic occurrence which calls on all of us to do better, beginning with ensuring that we learn everything we can from this tragic incident. And in that regard, we launched an immediate investigation to determine the root cause of the incident. And from that, we are conducting a gap analysis against the findings and are developing associated action plans. With this incident, what this incident reinforces is that we can never, ever waver from our focus on safety. And I can assure you that the board itself has gone through the incident in detail, and the Safety and Sustainability Committee, and Mike Asher, as chair of that committee, has spent an awful lot of time getting the learnings out of it, ensuring that we're doing absolutely everything we can to achieve our vision of ensuring that everyone goes home safe and healthy every day. Turning now to our financial results. 2013 was the year that saw challenging market conditions and significantly lower commodity prices. But in the context of massive write-downs across the mining industry of over $100 billion, Teck remained strong. Our revenues were $9.4 billion, with gross profit of $3.7 billion and adjusted profit of about $1 billion. And while these numbers are down compared to 2012, due mainly to lower commodity prices, we continue to maintain a healthy balance sheet. We closed the year with a cash balance of $2.8 billion, and we have minimal debt due over the next 3 years. We have also returned cash to shareholders of almost $700 million through dividends and share buybacks during the year. And we are continuing to return cash to shareholders with the announcement yesterday that our board has approved payment of another dividend of 45 cents per share. Now, in light of current market conditions and commodity price declines, we have taken further steps to manage costs. In 2013, we exceeded the goals of our cost reduction program. We had identified over $380 million in ongoing potential cost savings, of which $360 million were implemented during the year. That $360 million in sustainable cost savings, even on a conservative enterprise value to EBITDA multiple, would be worth several dollars, $4 or $5 per share. And this is in addition to $150 million in one-time savings that have been identified to date. Thanks to the hard work of our employees, this program reduced our controllable operating costs across all of our business units in 2013. And more importantly, each of our operations maintained a positive margin throughout 2013. In addition, we are prudently allocating capital to the most attractive projects and have deferred a number of projects and their related capital expenditures. And we are committed to doing more in 2014, which is why yesterday we announced a number of additional cost reduction measures. All sites and corporate groups will now reduce spending by at least 5% or another $200 million from budgeted levels. And as part of this initiative, we will be reducing our workforce by at least 600 positions over the next 6 months. Part of that will be through attrition and regular turnover. We are deferring our Quintet project and placing the site on care and maintenance. Haul trucks and other mining equipment will be relocated from Quintet to other Teck operations, and that will reduce short-term sustaining capital requirements by at least $60 million. And in addition, sustaining and development capital will be reduced by $150 million in 2014. With these additional steps, we are continuing our strong focus on cost reduction to maintain our competitiveness and ensure that we emerge stronger from this current price cycle. On the operational side, I'm pleased to report that we met or exceeded our production guidance. In fact, we achieved our second highest annual copper production ever, and we exceeded our 2013 guidance in all 3 business units. This demonstrates the resiliency of our asset base and our ability to meet production targets while controlling costs. At our operations, we also saw a number of milestones in 2013. We achieved record annual coal sales of 26.9 million tons. And this was a 12% increase from 2012 and 1.9 million ton higher than the previous record. And Q3 in particular was outstanding with record sales of 7.6 million tons, just demonstrating what the logistical chain can do in terms of transporting our product. We also saw record throughput at our Antamina, Carmen de Andacollo, Green Hills, and Red Dog mines. And we received regulatory approval from the Government of British Columbia for our Line Creek Phase 2 project, which will maintain that mine's production and extend its life by 19 years. And we announced construction of the Fort Hills Oil Sands project along with our partners, Suncor Energy and Total from France. Teck's leadership in sustainability was recognized again by several of the world's most credible corporate sustainability rankings. We were named to the Global 100 Most Sustainable Corporations list for the 2nd consecutive year by Corporate Knights at the World Economic Forum in Davos, Switzerland. And this year, Teck was the only mining company worldwide to make the list. And that might be good for us. We would like to see, though, more members of our industry on that list. We were also named to the Dow Jones Sustainability World Index for the 4th consecutive year, ranking Teck's sustainability practices in the top 10% of the world's largest public companies, and in our category, we're the top 2%. And just last month, we received the 2014 Globe Award for Corporate Environmental Excellence at the International Globe Foundation Conference. And while we know we have more work to do in sustainability, these awards do demonstrate that we are moving in the right direction. Operating responsibly is something we're focused on regardless of market conditions because it's just the right thing to do and because it's foundational to our long-term success. I wanted to spend a bit of time now discussing our current operating environment. Since 2011, spot coal price, copper, and zinc prices have fallen by 69%, by 34%, and 20% respectively. And that's the top line. The margins associated with those businesses have fallen by even larger percentages. And this requires us to focus on our existing assets and our core strength as mine operators. The margins, for example, in the coal business are down by 90%. These things aren't flashy, but they are the nuts and bolts of what has made Teck successful. Things like truck productivity, maximizing plant throughput, and optimizing plant yield and recovery, all of which ultimately results in lower costs. The investments we made before the market shifted will ensure we are well positioned to come through this current cycle. Investments like our renewed truck fleet at our steelmaking coal operations. Since 2009, we've reduced the average age of our haul truck fleet by close to 35%, and we've moved the size of our trucks from a fleet primarily of 240-ton trucks to a fleet of 320 and some 400-ton trucks. The maintenance shop at Fording River, which is pictured here, tells the story. As the trucks get newer, they're also getting bigger and as a result more efficient. As you can see in the image, with each new fleet of trucks, we've had to build new maintenance shops to accommodate their larger size. We've also added 10 new shovels. This new equipment means we are moving more material in the same amount of time with the same number of workers, and that reduces unit costs. And it's the same story at our plants. For example, the new mill at Highland Valley Copper was built at a design capacity of 130,000 tons per day. And yet in March, the first full month it was operating, we ran at an average of 139,000 tons per day. And on one day, we achieved a record 175,000 tons per day. And this is immediately post-commissioning. So I can tell you we are very pleased with the early results at Highland Valley. And by the way, this compares to the old mill, which was running at about 120,000 tons a day. The investments that we've made to replace and modernize our plants are ensuring that we maximize yield and recovery at our operations. And that means that we're getting the most out of every ton of material we process, every ton of our valuable resource. But as with any piece of equipment, it's only as good as its operators. And we are focused on being the best operators in the business. And we know from benchmarking that Teck already stacks up pretty well against its peers, but we can do more. And with the appointment of Ian Kilgore as our Chief Operating Officer last summer, we are more focused on benchmarking and driving best practices across our business. And we are seeing results. Haul trucks are the workhorses of our operations. Even a small improvement in truck productivity can have big results when multiplied across the business. For example, in coal, we recently implemented a system that provides truck drivers with comprehensive feedback on their productivity. This system allows each driver to monitor their performance and better identify opportunities to improve productivity. Further, the system allows us to identify our most productive drivers, allowing us to learn from them and establish achievable benchmarks that then drive continuous improvement. And since the system was implemented, we've seen truck productivity improve at every one of our coal operations. We are now expanding this system to the other business units. Another example of productivity and increasing efficiency comes from our work in sustainability. What started at Highland Valley Copper as an initiative to reduce our greenhouse gas emissions has actually become part of our cost savings program. Historically, our large haul trucks have been left idling during shift changes and breaks for maintenance reasons. But by focusing on improving energy efficiency, we were able to overcome the maintenance challenges and implement an anti-idling program. We've now implemented that anti-idling initiative at all of our operations, and the results are very significant. Last year alone in BC and Alberta, the program saved almost 5 million litres of diesel fuel. And in a similar vein, the installation of new lightweight truck boxes at our coal operations allowed us to increase our haul efficiency and reduce diesel usage by the equivalent of another 1.2 million litres. So these performance improvements are good for the environment and they're good for the bottom line. And they demonstrate our capacity to innovate and create meaningful savings. You know, over Teck's 100-year history, we've faced tough market conditions before. And in the past, we overcame these conditions with good people and good assets. And we've still got the good people, and we've still got the good assets, and now we have modern equipment across our operations. We've never been more prepared to come through challenging market conditions and emerge in a strong and competitive position, and that's exactly what we're going to do. Shifting now to market outlook, while we continue to see strong demand for all of our principal products, it is true that increased supply of steelmaking coal in particular has had a negative effect on the coal prices that we receive. Coal prices are currently at their lowest level since 2007, and margins are at their lowest level in more than 10 years. They are, in fact, worse than they were during the global financial crisis. We estimate that as much as 35 to 40 million tons of global seaborne traded steelmaking coal is currently being produced at a negative cash margin at the current prices. And clearly that's not sustainable. Fortunately, we are starting to see some curtailments, but more is needed in order to bring the market back into balance and achieve better pricing. We've seen several announcements in the last week or 10 days, but we're still looking for more. Now, the outlook for copper is a bit more positive. We know that new mines are developing, and there is an expectation of a surplus this year and next year. But that is not likely to last much longer than that, given how difficult it is to bring new copper production online. So we think we'll be back in deficit in pretty short order, probably in 2016, which would put upward pressure on prices. And we had presentations at the board meeting this morning on what's going on in Chile. And Chile, of course, is the largest copper producing country in the world. And the largest producer, in fact, is Codelco, the state-owned company. And we saw charts showing that their production is going to fall by 1 million tons in the next 8 years. So that's quite significant. There are also positive signs in zinc. This past year, we saw the closure of Brunswick Mining and also the Perseverance Mine. And they marked the first in a series of closures that are anticipated, including the closure of the large Century Mine in Australia. These closures are expected to remove more than 1.5 million tons of zinc metal production from the market by the end of 2016, which is not that far away. And at the same time, zinc demand is continuing to increase. In fact, it was up over 8% in January. And it's driven in large part by continued increases in the rate of galvanizing steel and strong auto production in the United States, China, and Japan. In fact, if China were to galvanize at even half of the rate of what the United States does, that would add an additional 2 million tons of demand to a market that is really 13 to 14 million tons in total. So it's quite material. So this means that we are likely to see a structural deficit in mine zinc production starting in 2015, and this is a deficit that we are well prepared to respond to. And as we outlined yesterday and that we have just announced formally, we will be restarting our Pend Oreille mine in Washington State. And as you will recall, this is an operation that we put on care and maintenance in 2009, and because of the work that has been done to maintain Pend Oreille, we are able to bring new zinc production online at relatively low cost. All major regulatory approvals are already in place, and we expect production to begin late in Q4 of this year at a rate of 44,000 tons per year of zinc. And with a 5-year mine life and the ability to process concentrate at our nearby trail operations, Pend Oreille will make a positive contribution to Teck's zinc production and operating profit, and we believe that it will go for longer than 5 years. With the reopening of Pend Oreille and with our existing Red Dog and Antamina production, Teck is well positioned to capitalize on coming improvements in the zinc market. The reopening of Pend Oreille also underscores the inherent strength of our diversification strategy. It allows us to deploy capital to the best growth opportunities where we will get the most value for our dollars. And while we are also providing stability during the commodity cycles, I think we have examples here of Fort Hills moving ahead, new zinc production at Pend Oreille. Red Dog is off to a terrific start and has had record throughput and production well above our budget. So the diversification does gives us some positives to balance out the negative situation in coal. Building an energy business will further diversify us and strengthen our company while also securing a natural hedge for our existing mining business. In 2013, we took a significant step forward with our partners, Suncor and Total, with the decision to proceed with the construction of the Fort Hills Oil Sands project. With an expected life of in excess of 50 years, Fort Hills is a natural fit with both our core skills of truck and shovel mining and our business strategy of developing long-life assets in stable jurisdictions. And I can't think really of a better geopolitical jurisdiction to do business in than Alberta. First oil is expected as early as 2017, and we expect it to achieve 90% of the planned production capacity of 180,000 barrels per day of bitumen within 12 months. Our share of production is expected to be 36,000 barrels per day, or just about 13 barrels per year of bitumen. Construction at Fort Hills is on budget and progressing substantially in accordance with the project schedule. And while we are currently in a phase of significant investment at Fort Hills, once online, it will immediately create value and generate significant cash flow. And we heard some numbers this morning, actually, that since the date of sanctioning the project, the price per barrel that we would receive is actually increased by $15 a barrel, due to compression of the discounts and slight increase in WTI and Brent. And that, of course, times 13 million barrels a year is a big boost to the returns for that project. So in summary, in spite of weaker commodity prices, our financial position remains strong. We are focused on cutting costs across our business and are carefully managing our capital spend to align with market conditions. The strength of our diversification strategy has put us in a position to be able to quickly bring new zinc supply online to capitalize on the expected improvement in the zinc market. And we are building an energy business that will create value, significant cash flow, and will further diversify our portfolio for decades to come. And what's more, we remain focused on returning value to our shareholders, as evidenced by the announcement yesterday of another dividend. And with that, I will turn the meeting back to Warren for questions. I think Warren's going to handle